Okay, traders, so welcome to the risk management section. Now, before we dive into the risk management section of the video, it's important that we go over a risk disclaimer once more. I know we've already looked at one at the beginning of the course, but it's extremely important that you guys understand all of this before we jump into risk management, because these videos in no way are me telling you how much you should start an account with or how much you should risk per trade. I am not personally capable of doing that for a slew of different reasons. I'm not a professional financial advisor, which means I cannot legally give you personalized financial advice on what to do with your money, how much money you should invest into this market, how much money you should risk per trade, things like that. Also, if I was to tell you that information, I would be doing you a disservice. I don't know your financial situation. I don't know your risk tolerance. I don't know you and your personality when it comes to how much you can risk without being uncomfortable. So it would be impossible for me to tell you how much you should risk even without the legal reasons why I cannot do so. So what I'm going to be sharing in this video is my own personal experience with the risk management I've chose to use in my own accounts with my own money. Our personalities may be completely different, so it's important that you do your own research. Only risk what you're comfortable with, and if you have any questions, if you're confused at all about risk management, then it's very important for you to seek counsel from a licensed financial advisor. So let's go ahead and quickly go through this risk disclaimer before we get started with the risk management section of this course. Trading foreign exchange or any financial market carries a high level of risk and is not suitable for all investors. Past performance is not indicative of future results. Before deciding to invest in the Forex market or any other financial markets, you should carefully consider your investment goals, level of experience, education, and risk tolerance. It is extremely likely you will sustain a loss of some or even all of your initial investment, and therefore you should not invest money that you cannot afford to lose. I am not a licensed financial advisor. Do your own research and talk to a professional financial planner or advisor in order to be aware of all the risks associated with foreign exchange trading before opening a live account or risking any of your hard-earned capital. All right, guys, so now we're going to talk about 4 main things that need to be in your risk management plan. Then we'll dive into a spreadsheet and talk about how we can calculate our risk per trade and base our risk per trade on the risk tolerance that you may have. So let's go ahead and dive into that, and I'll see you guys there. Okay, traders, so the 4 things that have been essential for me personally in a trading plan are risk capital, total exposure, risk per trade, and max acceptable drawdown. And we're going to go through each of these individually to help you guys better understand what they are. Risk capital means an amount of money that you could lose and not be uncomfortable when it comes to your financial situation. So when it comes to opening a live Forex account, you're taking a lot of risk doing so, and it's important that you realize that and don't use the money you have to pay the light bill with next month or the money you're saving up for a rainy day in order to open a Forex account with, or in order to open any kind of financial account with or investment account. And the reason for that's not just because you could lose all of that money. That's not the only reason for using risk capital. Another reason is because your emotions will have a very hard time handling you putting your entire life savings into an account and then risking money that you have saved up in case something goes wrong, or risking money that's all the money you've ever saved in your entire life. Whenever you put yourself in that kind of situation, you're setting yourself up for failure because your emotions are going to have a hard time handling that whenever you go through inevitable drawdowns, especially if you're risking all of your money. So it's important to risk an amount of money that you would be comfortable losing and that it would not affect your financial situation greatly if you lost that amount of money. Now, again, if there's anything you don't understand about risk capital, then you need to speak to a financial advisor, because this is something that I cannot tell you. I can't tell you how much you need to start an account with because I don't know your personal financial situation, nor am I legally able to do that. Now, the next things we're going to talk about are total exposure and risk per trade. These 2 things are going to correlate. Total exposure is going to be the percentage amount that you are comfortable risking at any one given time out of your account. And the reason that correlates with your risk per trade is because of this. Let's go ahead and do an example here. Let's say that you are comfortable risking 6% at any one given time. Let's say you wake up on Monday morning and there's a lot of trades out. You see 10 or 11 different trades that you could get into on Monday morning, but you know that your total exposure that you're comfortable with is only 6%. The reason you want to have a total exposure cap is because one day there may be a news event that happens or something crazy that happens in the market, and it ends up causing you to lose all of the trades you're in. So if that's the case and you have a 6% total exposure, that means that, let's say you're risking 1% per trade, and that's what your deciding to do per trade, that means you can only be in 6 total trades at once. Total trades at once. So you can only be in 6 total trades at once if your risk per trade is 1% and your total exposure that you're comfortable with is 6%. The reason these two correlate, if we do this once more and just change our risk per trade, let's say you risk 2% per trade of your total account value and you have that same 6% total exposure risk, then you're only able to be in 3 total trades at once. So that's how those two things correlate. Total exposure is the total amount you're willing to be exposed in the market at any one given time based on the number of trades you're in. Risk per trade is the percentage of your account that you're willing to risk on each trade that you place. Next up, we're going to take a look at max acceptable drawdown. What is this? Well, this means that we have a max drawdown, right? We have a max drawdown that we calculate from our back testing, forward testing, and what we've done so far trading live. Let's say your max drawdown is 10%. That's what you've seen in your back testing results, and that's what's been happening so far in your forward testing and in your live trading. 10% is the max drawdown you've ever had. Well, a max acceptable drawdown is a point where you get so uncomfortable that you stop trading and reevaluate your strategy and your own personal performance. So what do I mean by that? Well, if you have a max drawdown of 10% so far, your max acceptable drawdown may be 25%. When you have a 25% drawdown, that's when you want to take a step back and say, okay, leading up to this drawdown, was it a case of personal flaw? Meaning, did I make a lot of trading mistakes in order to lead up to this? And if that's the case, then you know you need to work on your trading mistakes. But if you had no trading mistakes and you ended up with a max acceptable drawdown, you ended up hitting that 25% drawdown, then that's a case where you need to reevaluate the strategy you're using. You may want to take and retest the strategy on different pairs. You may want to retest the strategy on the same pairs, but using the data we now have throughout the live trades we've taken. And you may come to a place where you end up having to completely change strategies based on what the strategy is performing like at this moment. And your max acceptable drawdown is going to tell you when that has to be the case. And again, guys, every one of these numbers is going to be extremely personalized, and I am in no way telling you what your max acceptable drawdown should be, what your risk per trade, total exposure, or risk capital should be. These are all things you'll have to decide for yourself based on what you're comfortable with your own personal risk tolerance. So now that we've explained a little bit about risk capital, total exposure, risk per trade, and max acceptable drawdown, you can go ahead and write all of these down. They are very important in your risk management plan. You need to have a place for each one of these, and you need to decide what each one of these numbers is going to be. In the next video, we're going to take a look at a spreadsheet, and we're going to see how we need to calculate risk per trade based on some of these other factors and based on our max drawdown to help us to create a risk management plan when it comes to the risk we need to be taking per trade that we take. So let's go ahead and jump into that video, guys. I'll see you over there.